You're listening to Navid Moosa of the Mindset Movement. Good day, good people. My name is Navid Moosa. I'm your host today and always for the Mindset Movement, the podcast. Long-time listeners, we appreciate you, your loyalty. First-time listeners, welcome. And what we try to do here is provide value every single day in all facets of life. I use it through real estate because that's my background. And I try to bring guests on whenever I can. And these guests that I bring on, hopefully bring you guys value as much as they did to myself and to my family. And listen, the purpose of this podcast has grown over the past 2-3 years. And it's always, the idea has never changed. It's if you want to be a better person than you were yesterday, you'll come to the right space. And that's whether it be through education or just through dialogue and going from there. So today we have Anthony Romano from RomanoCastellum agency. Welcome. Thanks for coming out.
Thank you, Navid.
So I'm here in PA and he's from New Jersey. So he drove down, right next door to come here to record this. And the reason why I wanted you here, Anthony, is I know we do business together and we talk in general. And lately on social media, someone had posted a video about this banking for the wealthy, this in infinite banking, infinity banking, however you phrase and stuff like that. And I brought it to your attention and like, well, yeah, it's possible. I'm like, well, shit, you never told me about it, So, but that's how we learn, right? We talk, we ask questions and we educate ourselves. So there's a lot to cover because,
there is.
And I mean a lot. And I'm not going to lie, if you're listening to this, you may have to pause and rewind, listen over and over again, because I had to pause him and rewind it because he was explaining some stuff that was way over my head. So having said that, that doesn't mean you guys aren't going to learn anything. That doesn't mean that this is for the ultra elite or for those who are super experienced. I've told Anthony, he's agreed so graciously, in the words of Michael Scott, explain to me like I'm 5 years old, right? Because insurance, I think insurance gets a bad rap personally. I think people find insurance boring, but I think they find it boring because they don't know what to ask, because it can be treated as it can be looked at as a scam. I tell people all the time, insurance and a lot of the stuff in life is almost like I was telling you before, it was almost like the phone. When your phone's on 50%, you're like, I got some more time. But when your phone's at 20%, 10%, and that low battery mode comes on and the red light comes on, you're like, you're all looking for the charger, right? So for an insurance policy, and for argument's sake, well, I'm just going to use the car insurance. When we get our policy for our automobiles, we just want the lowest possible payment. That may mean a $2,000, $1,000 deductible. As long as we get that lower payment, that's fine. And then we get into a car accident. Then we're like, shit, I got $1,000 deductible. Well, you wanted the lower payment, right? But no one thinks about insurance until they need it. And
not only that,
right?
When people think about insurance, they think about what am I going to get in return if something bad happens?
Yes.
Not how can I utilize this plan or this policy, when everything's going great.
Yeah, and absolutely, because every time money goes out, we want to get something for it, right? So we pay our cable bill, we can turn the TV cable comes on. We pay our cell phone bill, we can get a text message. So when we pay for something, we're so used to seeing something, an initial benefit from the door. That's not insurance, at least not all of it. So I don't even know where to start, right? So let's talk about this banking for quote unquote banking for the wealthy, as it said, banking for the wealthy, this infinite banking system. Let's kind of start from that and let's just see where it goes.
So there are certain plans, there are certain strategies that we use insurance products for outside of what your normal retirement plan with your employer, your 401ks, your IRAs, right? We use this infinite banking system, right?
Okay.
Basically building our own bank by funding a policy, not for the specifics of a death benefit, but for cash value that grows over time.
But the death benefit is there.
Death benefit is there from day one, depending on what your contribution is, depending on how we structure, right, our plan. The death benefit is there from day one.
Okay.
Right. And there's a cash bucket, right, in this plan that we put together that will grow tax-free over time. And it's distributed to you tax-free before your retirement age. So you're basically using.
But you're funding it with after-tax dollars, though.
Funding it with after-tax dollars.
Okay.
Right. it works almost like a Roth IRA
Okay.
with no ceiling, no cap. Right? You just have to commit to a certain contribution on a monthly basis.
And because a Roth IRA has a cap of
6,000 annual
annually.
Contribution.
Okay.
After you're 50 years old, you're allowed 7,000 contribution.
Okay, but
that's it.
But in this, you're saying someone can contribute.
And with the Roth, you have to wait till you're 59 and a half to touch that cash in that policy.
And when you touch the Roth cash, is that taxed at that time?
So no, so a Roth IRA will grow tax free.
Okay.
And you can take that money out
tax free. Okay.
Once you hit the retirement age.
Okay. So we're going to discuss
certain people, just to interject a little bit.
Yeah.
Certain individuals that are over income requirement. There are income requirements where you're not able to contribute to a Roth.
Okay. All right.
Right? So we use this almost as a alternative.
All right.
Right?
So
tax-free plan.
So far y'all with us, right? So for those who have an IRA, individual retirement account, there's different one. There's SD, self-directed. There's Roth IRAs, educational IRAs. And they all have limitations on what you can and can't do with them. First, and I probably should have said this to begin with. This is not financial advice, right? Not financial advice, not legal advice. I say the same thing too, just in case. Make sure you're legal. Okay. So he's agreeing it's not financial advice. We ain't trying to get sued. But we just want to educate you guys the best we can. And I'm still trying to educate myself learning this. I'm 47 years old at the time of this recording. And I guess some people call it late bloomer. As far as financial education wise of getting myself set up. But I don't want my kids to have that same path. I don't want my audience to have the same path. I definitely have nieces and nephews who are half my age or more than, less than half my age, if you will, or more than half my age, however you want to phrase it. So this is not just for, as I said, we're not just for the ultra rich. This is for anybody. If you're working, okay, if you're 15, 16 years, you're working, they can do this. Is that accurate?
The ultra wealthy, these plans, like, why can't we?
Okay.
There's no contribution that you have to make.
And this can be substitute for not substitute for 529, but in addition to a 529 essentially.
Exactly.
Right. Okay. All right. So what does this look like? Now I know you talked about the thing called, Foursquare. I'm using that. I know it could be more squares.
Yes.
And you use that as a way for people to kind of figure out, because again, let's be honest, right? Sorry. So let's be honest. A lot of us don't budget. We don't. We just know, here's my paycheck. I get paid on this day and I got these bills to go out. Whatever's left over is for groceries and spending money. We don't know what that leftover amount is. We just know there's a dollar figure. We don't say 10%, 20%. We just say whatever is left over. And I think that's a different discussion for a different day. But I think I think your approach, the Foursquare method approach, is a good way on dual purpose for people to realize what they truly have left over and what they can contribute to create the system. So
exactly. So
you go ahead.
In a nutshell, what I like to call it is 4 squares. So what we do is we try to figure out, at the end of the month, right? We break it down on a monthly basis, right? You write down the money that you have coming in, right? And your necessity expenses, whether it's your mortgage, your rent, right, your car payment.
So is it fair to say your necessity expense are your fixed expenses, like
your fixed expenses? Exactly.
Okay.
So I'll have you do an exercise where you write down all the money you have coming in on a monthly basis, all the money you have coming out. Right?
Okay.
And that figure, right, that dollar amount that you have at the end of the month, right, that's going to be your spendable income. That's going to be what we have left over. Right? And most people say, hey, I don't know how I'm making all this money. I don't have that many expenses. I don't know where all my money goes. All right.
So we're going to actually show you guys that. So he's going to actually do a Foursquare one for us real quick. And then we're going to kind of see how that goes.
So we have somebody, they have 5,000 of income coming in every month.
Okay, so that's take home pay.
That's take home.
Right. Okay.
Their bills or expenses are $2,500 a month.
Okay.
Right. So we're going to have 5,000. That leaves us with 2,500 in excess, right? That's our spendable income at the end of the month. So what gonna do is we're gonna take that 2,500, we're
Yep.
gonna divide it by 4.
Okay. Okay. Like 625 rate or something like that.
625.
Yeah.
Okay. Four square. Take the piece of paper.
Okay.
I want you to take 2 squares. Right?
All right.
Hold on to 2.
Okay.
I want you to take the other 2.
So I got 2 squares at 625 in each one.
Take the other 2 and put 2 aside.
Put these 2 aside?
2 to the side.
Okay. So we'll put them right there.
All right.
Okay.
So that's right there. You have in your hand. You have around 1,250.
1250.
Right.
Yeah.
That's 1,250. Divide that by 4.
1250 divided by 4. 315.
315, something like
roughly.
that.
Yeah.
So you're gonna, after all your expenses are paid,
Yep.
right? You're gonna have around $350 a week. Do whatever you want with.
Okay. So we did 5,000 take home pay, 2,500 out the
500
door,
going out.
2,500 left over.
That includes all your expenses, right?
That's your groceries, your mortgage,
all
car
that stuff,
note,
right?
cell phone, everything.
Exactly.
Okay, so then we have 625 left over because 625 essentially is $2,500, $2,500 divided by 4 weeks in a month on
Yes,
average.
correct.
So we have about 625 left over per week.
625 per week. No, so
625,
315 per week.
315 per week, which is
If you want to break it down on a weekly basis.
gotcha. Okay, gotcha. All right, so go ahead.
All right. And again, we can
Yeah, it can.
right? We can add a square depending on what the numbers come out to be.
Okay.
Whatever makes you comfortable. If you can live on $315 a week in excess money, whether you're going to get nails done, you're going to get a haircut, right?
Okay.
You're going to go out to dinner, whatever it may be. The other 2 squares now,
The 2 I put over here.
2 you put over there,
Yep.
right? That's $1,250 a month that we have to allocate.
Okay. So we're gonna do something with this money. It ain't
Gonna
just
do
not just gonna
something
sit
with
there.
that money.
Okay.
That money is just not, what happened to my money? Where did it go?
Okay.
Right? Because we broke it down where we already paid your bills, right? We're giving you some excess spending money per week, right? Now we're showing some discipline where we're taking 2 of those squares and we're putting that money to work for you, right?
Now-
you work hard for your money. Now we want your money to start working for you.
And there is no minimum for this, right?
There's no minimum.
So, and I'm bringing that up because some people probably gonna say, I mean, I don't got $300 left over every single week. And that's very realistic. Okay. I get it. We all get it. We understand that no 2 people are like, everyone's financial situation is different. However, this exercise, as Anthony alluded to, if we need to do more squares, we do more squares. Right. So if you don't have the 300 or the 600, whatever the dollar figures are, even if it's $25 left over a week.
Exactly. And there's different things come up every month.
Yeah.
Right? You may have to fix your car. You may go on vacation. You may have a wedding to go to. Right.
Yeah.
Maybe we'll have to dip into that 3rd square or take the whole 3rd square.
Okay.
Right? But at the end of the day, we want to at least put that 1 square away.
Okay.
Right? We're putting that to work.
All right.
Perfect world. You take half of that, right? 2 of those squares, and we.
All right. So we're going to live in a perfect world for now, for all intent and purposes. And then, so I got 2 squares over here. We're going to put them to work because these 2 squares over here are doing what now? What are these doing?
Those 2 squares you can spend whatever you like to.
Okay. So this is my money.
That's your money.
This is the money that's going to work.
That's your play money.
This is the money that I worked for that I'm not going to put to work. So it works for me.
Correct.
Is that the best way to put it?
Yes, correct.
Okay. So we got it. I got 2 squares. This is mine. I do whatever the hell I want with it. This is one to get me out of my W-2, essentially. That's what we're going to try to do, or at least create some kind of our infinite banking system for ourselves.
Correct.
All right, let's go.
So the rule of thumb, what I like to do is 5% of the money you're bringing in.
Yep.
If you can.
Yep.
We'd like to put into some type of product that's going to work tax-free.
Okay.
Because most of the products that we have, most of the products that are out there, that your employer provides, are all going to be taxable. They not touch this money until
To your
retirement.
59 and a half, 65 and a half, whatever the ages are.
So in this scenario,
Yep.
right, 5% of that 5,000 coming in
Yep.
is $250 a month.
Yep.
So out of that $1,250 a month, right, we're gonna take $250. Right.
So remember that 1250 came from, we had 625, 2 square, 625. That was a 1250. 5% of the
income
we're making
on a monthly basis.
Okay.
Right, which
Yep.
is the 250. We're going to put into our own banking system. Right, we're going to put that into our own banking system. It's going to grow tax-free, be distributed to you tax-free, and you have access to this pool of money at any point in time before retirement. And
Okay.
so rather than using money from your bank, you are going to use money from your infinite banking system to fund any, future investments
Investments
it
that
could
you
be
have.
anything, that you want to use it for, but it's you're going to get paid a dividend, right, on this money rather than making nothing in the bank and getting crushed with inflation.
Yeah.
You're actually losing.
We're actually losing money at that
what's
point.
happening right now.
Yeah.
Gas, milk, eggs,
Yeah, everything, air.
right? Everything. So the 250, right?
Yep.
We're gonna safely put into our banking system.
So look at the 250 this way, guys. Look at the 250 is you investing in yourself. 250 is like your seed money, right? Your seed money to start your own business, and your business has to be this banking business you're gonna get into, this infinite banking system. So it's 250, and I'm saying that this way is because I don't want a lot of people to think we're so used to, like we said before, you pay a bill, you pay your cell phone bill, your cell phone works. You pay your cable bill, you get to watch TV. When we pay something, we want to see something in return right away. This is not going to see something in return right away. I'm not going to put in 250 on Monday and be able to draw 500 on Tuesday. This is nothing like that. This is not a get rich quick scheme. We're not talking about get rich. We're talking about wealth. We're talking about wealth building here. So please keep that in mind. Rich is one thing. Wealth is different. Rich is a one-night stand. Okay. Wealth is a long-term relationship. So if you're thinking you're going to do this so you can start investing on January 1 of 2022 and then get paid and be on the easy street January 1st of 2023 at only $250 a month, no, it's not going to happen. Being very honest with you guys, okay? I just don't want anyone thinking that they're going to do this to get rich quick overnight. We're talking about building wealth for you, your spouse, and your children. But you're never too old or never too late to start.
And not only will this be, nobody likes taxes, right?
Yeah.
Not only will this be a tax-free vehicle.
Yes.
But unlike most products, it's going to be very functional. Where it's going to take a little while to build, but you're going to have access to pull money from this at any point in time.
Okay. Remember, y'all bust your asses and pay taxes and you get paid. Now you can get money you are making and make it work for you. That's the idea of this. It's for your money to start working for you. So let's go. So we put in 250. Now what we're doing?
Put in 250. Now you have the other 1,000.
Yep.
To allocate, right?
Okay.
You can speak to your advisor. You can speak to anybody.
Speak to you.
Speak to me.
Speak to you. Okay.
Speak to me. And figure out where can we put this other 1,000, right? Some people, are looking to buy a home or invest with Navid in a real estate project very in the near future.
Yeah.
Right. So you can start allocating that money into a different account. You can open up different retirement accounts as well if you'd like to, but it's just basically forming some discipline and giving yourself a visual of what money do I have left over at the end of the month and where is it going?
Yeah. So this, right. I hope you guys are catching this. I see a lot of stuff being, like a lot of dimes being dropped, as the kids say, right? Because this is not just get you ready for what you're talking about, but I think everyone just needs a budget, period, to begin with. And this 4 square method, I think, is an amazing way to at least get it started.
You're making yourself aware of
of what you have, what you don't have, which I think is hard, right? Because people don't want to admit. I think it's probably a lot of times people don't do a budget is they don't want to face the reality of shit, I'm spending my money and I don't know where it's going. And this is going to let them see where it's going.
I mean, at the end of the year, some people look and they don't realize, oh, I'm paying for 2 or 3 subscriptions that I don't use.
Yeah. Where they really could be putting the money into this, and that's the beauty of it. There's no minimum, stuff like that. So, I hate to keep it. I don't want to keep, and I'm sorry if I'm pissing you guys off for interrupting him. I just want to make sure that everything gets covered to the best of the ability. You're putting in $250, the other $1,000. They talk to you for advice. They talk to me for real estate investments, whatever. They've decided to do something with that they're comfortable with. Fine. That's January $250, February $250, March $250, April $250. So I've contributed $1,000 over the 4 months. Okay. Now let's talk about, everyone talks about policies and stuff like that. Again, it's not financial advice. I'm not going to hold you to the fire here, but can you give me a rough idea? 35-year-old person, 20-year-old person. What are we looking at? What are the numbers I actually look at these ages? 50-year-old person, I don't know, whatever you want. Oh, he's bringing up some shit for y'all now. Y'all in trouble.
So we're gonna go with the 250 number.
Yeah, you tell me. I'm sure we can go higher and lower and stuff like that, but what I don't want is people to then think, well, I don't got $600 laying on every single month, stuff like that. But then again, doing the Foursquare thing, they may realize they got $600.
And again, listen, with the 1,250 left over, right?
Yep.
If you're not allocating, that money into something different, you could push yourself, right? You could do 500 a month
Into this one, okay?
Right. So I have an individual that's putting away $500 a month.
Okay.
34-year-old.
Okay.
So from day one, right? $6,000 annual premium, $500 a month, however you want to fund the policy.
Okay.
Day one, the death benefit's $334,000.
All right. So 300 and what?
$334,000 for this specific individual.
334.
Healthy individual.
Death benefit.
Correct.
And that means basically at $500 a month. $500 a month. And let's say that individual is me. I'm 34 years old. 34 years old. Pretty good health for the most part. We understand there's variables about underwriting. We get all that. We're just gonna make some assumptions here. That I'm 34. I'm putting in $500 a month as a death benefit. I'm married with children. In 5 months, I've put in $2,500. And then on the 6th month, God forbid, come June, I'm done. My ticket's been called. My man upstairs says, I need you up
Put
here.
3,000 into the policy after 6 months.
What happens? What happens at $334,000?
So your beneficiary,
Yep.
in this case, right, would be your spouse.
Yep.
Would collect tax-free almost $335,000.
Although I've only put in $3,000.
Only put in $3,000. So that's your safety net in terms of, right, covering your kids going to
funeral,
school,
or school costs, whatever.
The income that's going to be missed from you not providing for your family.
Okay.
Right. So that's your safety net right there in the short term.
So think about this. For those listening and watching, wherever you're getting this information at right now, we always want to talk about, we're priceless, right? We're priceless things. We're invaluable. Your policy is going to speak, let's admit it, to your value, to an extent, of course. So if you want to be cheap and get $100,000 policy, so be it. But if you're going to talk around here and saying that you're this and that, and you're going to provide and be the ultimate person to help, then step up your game and get the bigger policy, right?
And listen, this is permanent, right? So a lot of people, whenever they hear life insurance, they think about
perm, hold, there's all these phrases.
20 year, 30 year.
Okay.
Right? If I die, my beneficiary is going to get the money. If I outlive the term, that's it, right? Money's out the window.
Yep.
I lose out on everything I put into it. So basically, there's 2 parts of this policy, right? There's a cash bucket, which is we're going to call our own bank.
Okay.
Right? It's our own banking system.
Yep.
And then there's the death benefit.
Yep.
That's there, if we pass away,
yep,
or when we pass away. If you live till 100, somebody's going to get paid no matter what.
So this monthly fee that we're paying, this premium, is feeding two beasts, essentially.
Right.
It's feeding your death benefit, and it's also feeding the cash value portion of it.
Correct.
Okay. How does that look? What is that year 1, year 2? How does that?
So in the beginning of your policy,
Yep.
right, most of the premium is going to go to fund that death benefit.
Okay. So death benefit is almost like a mortgage.
Pretty much.
Right there. You make a mortgage payment, bulk of it goes to interest.
Most of it goes to the interest in the beginning of the policy.
Okay.
Or the beginning of the plan.
Yep.
Right. So with this product, in the beginning, most of the premium is going to go towards the death benefit. But over time,
It'll swap.
It's gonna go more towards the cash. You're getting paid a dividend on that cash that you're putting in, and it's almost like pushing a snowball down a hill, right? It'll be a snowball effect where the cash is gonna grow, the
Keeps
death
going and
benefit's
get
going
bigger,
to grow.
bigger. Okay.
So you're gonna have two different buckets that are going to increase over time.
Okay. So a dividend is, you'll get the dividend off of the money you've already put in.
Right.
Because it is a bank. Remember, we talked about this. You're creating your own bank.
It's your own
and
bank,
banks pay dividends.
And basically what you are is, it's not a bank. It's a mutual company where you're a policyholder.
Okay. All right.
So what you're doing is you're basically participating, right?
Yep.
In the company's profits, and you're getting paid a dividend
Off of that. All right. So one payment is creating two different avenues of financial security.
Yes.
For your family. One is the death bucket, as you said. The other one is this fund that you're putting your money into.
Exactly.
This
Which
bank we're
you
creating.
have access to, right, along the plan.
So I can access from day 1, day 21.
You can access day 1, day 60.
Doesn't matter.
Year 5.
Gotcha.
Right?
Okay.
But the purpose of this plan is to give it some time to grow.
Yeah.
And you want to have access and use this cash before retirement, right? Because let me ask you this: if you look to fund an investment property, right?
Yep.
Where do you get that money?
I'm going to go to a bank. I'm going to go to a lender. I'm going to go to someone who gives me the money for it.
And so number one, when you put your money in the bank,
get nothing for it.
you're getting a fraction of a percentage on
fraction
it.
of a cent. Yeah, exactly.
Right? Fraction of a percentage on it. And with inflation, right, you're essentially losing
money. Yeah.
Putting it in the bank. Right. The second thing you said is you're borrowing money from a lender.
Yeah.
So when you're borrowing money from a lender, you're paying interest.
Absolutely.
So
absolutely,
what we're doing right now is you're funding, right, your own system where you're getting dividends on that cash. And when you take money out, you're borrowing it. Essentially, you're taking a collateralized loan from your policy and you're borrowing it for yourself.
So I'm borrowing for myself. I'm going to pay myself back with interest.
Correct.
And who decides that interest?
So the interest is based on, the interest rates.
Okay. So whatever Federal Reserve says, prime plus and all that other stuff. Okay. Gotcha. All right. So it's not like if I'm not a seasoned banker, I have to figure out interest rates and taxes and all that kind of stuff.
So the money that you're taking out, right? Let's say
I take out 100.
We'll give you an example, right? Let's say you take out 50,000 from your policy.
Okay.
There was 100,000 in there.
Okay.
Right. You're still going to get your dividend on that 100,000 of cash that was in there.
Although I took out 50 grand.
Although you took out 50 grand, you're still going to get a dividend on that full amount.
Okay.
And you're going to pay a loan amount, right? A loan interest rate
off the 50
50,000 that you took out. But essentially it's a wash because you're getting a dividend still on that 100,000.
Well, yeah. Plus so you're also still paying yourself back.
Right.
The interest rate.
You're still funding your policy. You're still paying that premium every month. So it's still growing. The cash is still growing.
So 100, and we're just going to use right now. I've got a cash value of $100,000 in my policy. Can I take the full $100,000 out? Was there a percentage?
So you can take up to 95% of the cash out.
Okay.
Without a tax consequence. Right?
So if I go,
we're looking to avoid taxes.
Yeah, correct. So, but if I go above 95, it becomes a taxable event.
It becomes a taxable event.
Okay. So we don't want to do that, right? You really don't want to take out 95% personally. I have $100,000 cash value in there. I'm taking out $50,000. I'm still making my monthly contribution for that premium. So that's still coming in for me. The dividends are still coming in based off the full value of the $100,000. Right? So that's a form of another form of income that way. I took this $50,000 loan out. I have to now pay that back to myself with interest. So that's more money coming back in. And if I'm smart, if I did it right, that $50,000 that I took out from that, let's just say that bought me a rental property. That $50,000 is collateralized loan, correct? You said, okay. I'm going to buy a piece of property with that 50 grand. and that's going to draw me income. I'm going to make $500 a month in rent. Let's just say off that. So I'm paying back this loan, and I got the dividends coming in. Plus, I'm making my premium. Plus, I now have cash flow coming in from the rental. Is that right?
Exactly. So,
Damn.
So the purpose of it is,
Holy crap.
so you're using, right? You're still making money on your policy, right? It's still working.
Yeah.
It's still working like your machine.
Yeah.
And you're taking that money out and you're putting it somewhere else to get a higher return.
So essentially, if I do it right, the asset that I purchased with the loan that I took out from myself to pay myself back could potentially make enough money where it's actually paying my premium for me as well.
Yes, correct. So that asset that you bought,
yeah,
the passive income that's coming in now funds your policy.
Y'all hear this? Damn, that's dope. There's no other way to put it.
And now, people always ask, what happens if I never pay it back, right? If I never put the money back in the policy, right? It might not, the cash might not grow, right, as fast as it would if you don't put the money back in the policy.
Understood.
And if you pass away, that amount that you took out is going to come off the death benefit.
Okay, so if I took out the 50 grand, I got a $300,000 death benefit. I now have a $250,000 death benefit.
Correct.
That's still fine because the asset that I bought, it doesn't matter.
So your beneficiary is still going to get way more than what you contributed to the plan.
Man. That's wow.
Now to switch the gear a little bit.
Okay.
So you give an example of taking money out, right?
Using
it for investment purposes.
Yep.
Now this can also be used as a supplement. Once you retire, like you're building up, basically you're
like a pension.
You're building a tax-free pension, right?
Okay.
So for an individual in this specific scenario, putting $500 a month away.
Okay.
Right.
So $500 a month, that's $6,000 a year.
$6,000 a year.
And do it for 30 years.
30 years.
That's
right?
180 grand.
So we're looking at 180,000.
Okay.
It's funded into the policy, right?
Yep.
You're done. 65. You're done funding the policy. Cash value, right? Total cash value at age 65 is close to 340,000. Tax-free cash that you can pull out in retirement. Because
you're putting in the $500 a month and you're getting a dividend off that.
You're getting a dividend and it's growing compound. Like I
So
said, the whole snowball effect.
Yeah. So it's the 180 you put in is actually
it's almost double what you put in. And you can't, and you're not going to get that type of return tax-free guaranteed anywhere.
Yeah.
So you can use that as a pension where you're drawing, let's say at age 65, right? You're almost $2,500 a month, right? That you can take out tax-free as a pension, or you can take a lump sum out. It's up to you, and you still have that death benefit intact.
Man, so you basically created a whole new pension plan on top of other pension plans that may exist,
right?
From your employee or from whatever other retirement stuff by doing this one thing.
Any other plans that you have set, right?
Yeah.
For your future, for retirement, you just created
an additional
tax-free pension to supplement, whatever you have going.
So I'm going to ask, it could be an obvious question. I know I have my insurance guy. Everyone has insurance guy. You're my insurance person. How come no one talks about this? Like, how come this is never brought up, or is it brought up in a way that is just intimidating? Like, does that make sense?
So that's a good question, and a number of reasons, right? I wouldn't say most, but many insurance brokers, right, insurance agents, they're trained to push, term plans.
Yes, that's what I hear all the time.
I mean, and there's a purpose for term, right? There's many purposes, whether you're looking to cover your mortgage, right? Whether you're looking to cover certain debts in case something happens to you, you're only one, and it's affordable, right? It's very affordable. But they have business partners, right? And you're looking to cover, each other's interests, right? Insurable interests. But term is, people make the most money on term, brokers or insurance companies.
Okay.
And why is that? Why are these insurance companies making the most money? Because the majority of of the clients, right? The majority of the customers are going to outlive that term based on life expectancy, right? Life expectancy is now it's like 85 years old, but there's a need for it to cover that gap where, the unexpected,
Yeah,
something
yeah, yeah.
does happen to you,
Yep.
you're going to need that coverage, but actuaries figure out, this male or this female, healthy or
Oh,
not, is
that's
supposed to
yeah,
live a
yeah,
certain amount of time.
yeah, yeah, yeah.
And that's why they sell it. This type of product, it may be too complicated for people to understand. People don't explain it well enough, and there's not as much value, right? There's not as much value in it
Yeah.
because eventually, as long as the policy stays intact,
Yep.
somebody's going to get paid out, whether you use the cash or not. The beneficiary, whether you live till 120 years old, that is going to get paid out. It's permanent. The benefit.
Okay. Because I was wondering, I'm like, this is such a good thing. How come they don't teach it earlier? Now, and I know financial education or general schools isn't discussed. And let's be honest. I mean, inner city schools don't get it, where some maybe suburban schools do. And even that's relatively new, and at least in my experience with I didn't get it at all in school. We were just taught, get a job, pay your bills, get married, get kids. That's it, right? But now my son is freshman in high school, and he's taking a financial course. Like he has to have stocks, and he's got to put this. Like they're teaching about stocks and mutual funds and
listen. There's a lot more information out now.
Yeah.
Right. There's easier access to information, right? In general now. So it is a little more accessible, but I'll give you an example, like a Jim Harbaugh, right?
Yeah.
Coach of Michigan. I don't know if he's gonna be. He's not at Michigan anymore now, but
No, he extended 5 years.
did he extend it?
He did a 5-year extension.
Okay.
He interviewed at either for the Minnesota job, and they didn't give it to him. He got it to someone else. And then he signed a 5-year extension.
All right.
As of last week.
so I'll give you an example. He has a plan just like this.
Okay.
Right? What he did is he's on a different level, but he's gonna have a $2 million pension every year at retirement. I mean, he's putting a ton of money.
He's put a ton of money.
Putting a ton of money in to fund the policy, but
Yeah.
it's all relative, right?
Yeah. But
if you're putting $500 a month and getting $2,500 a month at retirement, tax free, it's amazing.
no, but and I'm glad you said that, right? Because what I don't want people to take away from this is that once they see these numbers of $2 million a year and $1,250 a month left over and $250 a month, they think, oh, this is not me, and they just log off and go to the next podcast, and that's it. That's not the case. There it goes, and you said it before. There goes with a certain discipline you need to do this. There has to be. You have to be disciplined.
And Navid, just to circle back, I want to go back to our 4 squares.
Yeah, go ahead.
Grab those 4 squares.
All right, so I got this is my money. This is working for me. This is my money. Do what I want to do with it.
Put them all together, right?
All right, so I'm gonna take my 4 squares here.
Right. So we had what, 2,500.
Yes.
Right?
Yeah, 60 up, $2,500.
You said you needed what to live on?
According to the example, 300 of
what was coming out every month?
$2,500 was coming out.
2,500 a month. Right?
Yeah, it was coming out.
And that was your excess.
Yes, 20. So basically 50% of my income was allocated essentially on a monthly basis.
Right? 50% was coming out.
Yep.
Now with this number right here, this is 2,500.
Yes, this
right?
is 2,500.
That
Correct.
we have
left over.
We have left over. Now, all I'm telling you to do is take out 20% of that. 20% of that 2,500 you have left over, which is 500.
Yep.
Right.
Yep.
So we're gonna take 20% of that 500.
Yep.
And what that's going to do is when it's time for you to retire,
yep,
it's going to create that $2,500 that you needed every month.
Already when I'm retired. So I'm glad you said percentages. Again, we're using examples. We're using a 20% number here. Let's stick with that. So if you have $1,000 left over a month, 20% is $200. If you have $500 left over a month, 20% is $100, right? So take that 20%, whatever left over.
20% of your leftover money.
That's what you want to use for something like this.
Yes, because essentially that 20% of your leftover money is going to fund all of your expenses by the time you retire. If you still have the same 2,500 going out.
Correct. Yeah. So it's the 80-20 rule, basically. So you're saying, hey, take 20% of it, live over that 20%. So that's what you're basically saying. Hey, listen, take the 20% out, your leftover, put it into a policy like this.
Plan, out of sight, out of mind.
That's
right?
it.
I mean, the purpose is to use the cash.
So can that, policy. And I don't know if you guys this, can that be done? Can it be where it's a direct debit where it comes out so people are like,
yes, it can come right out of your checking account.
Okay.
Or savings account.
And the reason why I say I think it's important because
it's important too, because some people forget to, you're not going to send a check. People forget to send a check in every month.
Absolutely. Now we're not going to forget to pay our bills, but
so I know money in that account.
I've got a few nephews who I ain't gonna call you out on this podcast, but you know who you are, who opened up an IRA and they've yet to fund it. They funded it initially when I told them to do it. And then I'm like, did you fund anything? No. Why? I wanted some rooms for my car. Come on, man. Because they had to write a check. But that habit goes into the rest of lifestyle. So, but a direct debit, like outside of mind, they don't even got a chance to spend it. They can't say, oh, well, wait a minute,
And that's why I do this exercise, because I ask you this, right? Once we have these 4 squares out, I ask you, what can you live on?
Yeah.
Per week, per month.
Yeah.
Right? That's what I want to know. So if you can live on a certain amount comfortably, right, excess money, then this comes out of your check every month, out of sight, out of mind.
Yeah.
You can live on
X amount of dollars, correct.
You can live on it's all relative.
I was just gonna say it's all relative. It's almost like when my wife and I first bought our house, a good friend of ours who was a realtor before I was a realtor. We were looking at houses, we got pre-qualified, looking at these mortgages. I'm like, we can't afford that, we can't afford that. And I'm telling him, we're getting cold feet. And he says, listen, you'll be amazed when you buy a house, you will work around what the house needs. You'll start cutting stuff yourself. I think something like this, in my personal opinion, not financial advice, my personal opinion, this needs to be looked at that, because I just had a discussion with my nephew last week, and very, very mature for 20 years old. And he said he's making decisions now for who he wants to be at 40. Now I'm like, screw you, because 40 is not that old. Okay, so hell with you. But I get his point. His point is that I want to make decisions now that when I am 40, I don't need to make those really hard decisions when I got cut and stuff like that, So for a 20-year-old to think that way is actually pretty impressive. But I don't want to scare people away saying, if you're 40, 47, 50, 55, listen to this, you can still take advantage of this. It all depends on where you're at financially. I get it. I'm not saying everyone has this kind of money laying around, but that doesn't mean you use that as an excuse, in my opinion. It means that it is what it is.
And if you don't need access to that money immediately, most people are putting it in the bank.
Yeah, we all want a savings account. Well, okay, make this a savings account that actually gives you a better return.
Put money aside for emergency sake.
Yeah.
But if you're not going to use that money, might as well make it work more for you.
Yeah.
Right?
How easily can this be accessed once you put into it? Like if I do want to buy an investment property,
yes.
I do, if I've got $100,000 in there, I want to buy a $50,000 property. How easily can that be done?
Very easy.
Okay. So it's something that it's not like I go through hoops and takes 3 to 4 weeks to process.
No.
Nothing like that. Okay.
You contact the company, you tell them you want to take a withdrawal.
Yep.
And
it's a matter of days.
It's very quick. Yeah.
Okay. Then we get it done. So you're not like hog tying the money up. When you
no, definitely not.
That. Okay, cool.
It's your money. It's your cash in there. It's like I said, it's just like, you want to look at it like it's your own bank.
Yeah. All right. So just a reminder, this is Anthony Romano from RomanoCastellum agency. And we're talking about how the wealthy keep getting wealthy and how they keep banking and how they create their own banks. And that's what we're doing here. That's what we want to do. We want to create this banking system for you guys. So we're going to take a quick break. We're going to come back and we're going to talk about, actually, don't tell them. Y'all got to tune in for the next episode, see what we're talking about. But this is going to be like a mini series that we're doing with Anthony Romano here. We're not done with this topic though, but we got some more to go on with you guys. So we will, for now, let your brain kind of relax and replay this episode a couple of times. Yeah, let it marinate a little bit and go back to it. We're going to do some more stuff here to do some more educational pieces on how you also can not just be rich, but be wealthy, and how you can create your own systems here within you create your own ecosystem within you and your family. Um, don't go anywhere. Please don't leave us.
Always
We,
great chatting with
we,
you.
we have a lot to do here. And each and every week, what we try to do is bring you guys value, like I said before. And each and every week, I end the episode the same way. And that's don't just do right by the client. If you do right by the client, everything else will fall into place. I promise you that. And sometimes you're the client. Take care of yourself and everything else will fall into place. That's one thing I can guarantee to you guys. Outside of death and taxes, just do take care of yourself first. Put yourself first and everything else will fall into place. So see you guys next week on the next episode. Anthony's going to be here. We're going to do some more educational stuff, talk about how you can basically leverage insurance to basically level yourself up to that next level. All right. Take care. See you guys soon.